Okay, so the Fed just came out with the FOMC meeting minutes for November 1st and 2nd. And as usual, the markets just reacted positively, thinking they're going to get slower rate hikes. But reading the document, it's like a little weird. So they say, okay, a slower pace in these circumstances would better allow the committee to assess progress towards its goals of maximum employment and price stability. The uncertain lags and magnitudes associated with the effects of monetary policy action on economic activity and inflation were among the reasons cited regarding such an assessment was important. A few participants commented that slowing the pace of the increase could reduce the risk of instability in the financial system. Okay, that's what they read. That's being positive. A few other participants noted that before slowing the pace of policy rate increases, it could be advantageous to wait until the stance of policy was more clearly in restrictive territory and there were more concrete signs that inflation pressures were receding significantly. So it's kind of like you can't have your cake and eat it too. You can't say, yeah, we're going to slow down rates. And then you say, well, some of us don't actually believe that we need to slow down rates until we actually see more positive data. So it's kind of like a toss-up. Rate hikes still going up. Okay, maybe we won't get 75, maybe we'll get 50. But they're still talking about being restrictive. They're still talking about going to a 5% or high 4% Fed fund rate. So what happens to the 10-year? Or what happens to the 1 year, the 3 month? Well, that's still going to be going up. What happens to mortgage-backed securities? Still going to be, going down. So they're just going to go at a slower pace, and I think that's a mistake because the markets are just going to jump on this and say, hey, we're getting lower rate hikes. So let's keep on jumping on the bandwagon and increasing asset prices. And then the Fed's going to figure out that if you do that, what happens? Well, inflation is going to stay higher for longer. And that's going to be the bad news. So Fed, again, not being very, very clear. They're saying there's risk in the markets, there's risk in global economy, but they're still, they're still saying, hey, we still need to get a fund rate to 4% and above, and they're still saying we need to increase rates. So it's just the pace. Do you want to get to 4 to 5% faster, or you want to get to 4 or 5% slower? Well, if you want to beat inflation, probably you want to be, going a little bit faster and getting there. And I think that's what the Fed made a mistake in 2021. And I think they're going to start making the same mistake again in 2020, late 2022, early 2023, by slowing down the rates. And then people are just going to keep on going out and buying. Asset prices are going to keep on going up. I don't think real estate is going to go up at all. I think it's going to keep on going down. But credit cards, consumer, expenses on things that they really don't need, like apparel and TVs and things like that, and services are, they're gonna spend a lot this winter, and then they're gonna be broke next year. So we'll see what happens. But right now it looks like let's look at what's going on in the stock market. Stock market is up. Oil is down. But that's more about price caps. But I think that's going to be going back up. Bonds are taking a small fall, but not much. Gold is up as usual. Crypto is jumping as usual. Because anything that's like lower interest rates, they jump on it. And then let's look at mortgage-backed securities. What happened when they got the news? Yeah, jumping up a little bit, 99.03. So expect some a little bit lower rates coming in next week. But overall, I think the markets are getting the wrong story because the Fed is flip-flopping, going back and forth, trying to eat their cake and have it too. So hold on to your hats. This inflation story is not over. Recession story is not over. You know, so it's still gonna be a bumpy ride in the real estate market.